following paid commercial program is brought to you by TD Wealth.
Welcome to Money Talk. I'm Kim Parley. Thanks so much for joining us. Coming up on the show, a court ruling involving day trading and tax-free savings accounts that could have big implications for frequent traders and the taxes they have to pay. Also on the show, why commercial real estate is making some investors nervous. We're going to separate the notable from the noise. But first, the Bank of Canada has kept interest rates on hold yet again, with the overnight rate sitting at 4.5%. The central bank says inflation is on the decline, but the job is not done. For more, we're joined by Scott Colbourne. He's Managing Director for Active Fixed Income at TD Asset Management. It is great to have you here.
Hi, Kim. Great to be here.
Great to have you. Let's start off with just what happened. So what did the Bank of Canada do today? Not much in terms of the rates, but what did they say?
Yeah, it wasn't a surprise to the market. It was on hold. You know, they didn't raise rates. You might interpret it as a bit of a hawkish hold. So, as your opening remarks said, is look, there's still a job to be done, and there is some risk potentially to the upside. But by and large, this reinforces the message that the bank is patient, data dependent, and most likely it's going to be on hold for the balance of this year, based on its outlook for inflation.
And they did talk about the fact that, inflation it's starting to see a little bit of weakness, but they also highlight that the jobs market is still very, very strong from the numbers we've seen, and the economy is still pretty strong.
Yeah, you've got some sort of conflicting or, different data points out there. On the growth side, Q4 last year was flat, and we've surprised to the upside this year, and we had a good jobs number. So that's, sort of leaned into the hawkish element for the Bank of Canada. Did they raise rates again? But, inflation, the Bank of Canada said, look, we're going to see inflation basically mid-year at 3%. And that's the good news story. And we continue to see, that work through the markets. And, we had sort of the same message out of the U.S. With the CPI data today as well. Look, inflation's on the right trajectory. Goods prices have depressed the headline inflation. So it's all a good story. But this is the data dependency, and the uncertainty is, look, going from 3% mid-year this year to 2% at the end of next year, it's a long, drawn-out process with a lot of uncertainty. So that's the risk. They also highlighted some risks, in the labor market, the wages, inflation expectations, corporate pricing. So there's some concern, and that's going to leave them in that data-dependent, watching the market. And to me, that really reinforces both the Fed and the Bank of Canada on this. Really, we're at the end, with a slight leaning to more rate hikes, but really the notion of a pivot or a cut that really got the markets going at the beginning of this year, or maybe at the beginning of March, look, that's really not going to happen.
It's interesting because, you pointed out to me as we were, coming in today too, just the equity markets, at first we're like, yay, and then it kind of... A little
sober,
yeah. A sobering effect near the end of the day. I'm sure that's not how they actually speak, but no. People get my point.
Yeah.
What maybe you could tell us a bit more what you're thinking about on that front, just about, that the pivot is like, let's not get carried away. Like, we're stuck with this situation for a while.
Yeah, and this is the notion of, we had a big inflationary shock, and when Governor Powell put it nicely. He gave us a framework for thinking about central banks, particularly with this inflation shock. Look, we had this rapid pace of rate hikes. We had all central banks rapidly raising rates. And then it's like, where does it go to? The terminal rate. And this is the debate. And, RBA, the Australian Bank, and the Bank of Canada, both on this conditional hold, and both those economies are levered to households, so and in the real estate market. So they went on this early hold. The bank, the Fed, maybe the ECB, they still have some more rate hikes to go. So you're definitely flirting with the end of rate hikes here. This notion of a terminal rate, and then how long do we stay there, and when do we move down? Earlier this year, and I referred to that, is that the markets had 3 or 4 rate cuts priced in the U.S. And that, there was a few things there. There was ISM that was weak. We had the Silicon Valley Bank crisis. Who knows how that could have gone, potentially negative, a lot worse. So markets did price in a lot, and I think we're slowly seeing that being unwound and pushed back, and basically central banks saying, look, there's no urgency for us to pivot in this inflationary environment that's coming down, but we still have elements that are sticky.
What are you, what you do, you watch the bond market in terms of the reaction. I know the bond market is telling you all this, but what's been the reaction in the bond market? What is it pricing in?
Yeah, right now, the Fed will get maybe it's got about a 75% chance of a rate hike in May. The Bank of Canada is on
25?
Rate hike, one hike,
Yes,
25 basis points,
right.
yes. And then it looks by the end of this year to take 50 basis points back, 2 cuts. So that's what's priced into the market in the U.S. In Canada, we have basically the Bank of Canada on hold with the possibility of a rate cut by the end of the year. Now, where we handicap that, why would they get to a point of rate cuts? And that would be a recession or a real transition on growth. And look, both the Bank of Canada and today's Fed's minutes spoke to the notion that we might see significantly softer economic growth and even the potential for a recession that was mentioned in the Fed's minutes. So that's sort of, you're handicapping odds, but that's where the trajectory is right now in terms of rate cuts. There's lots of uncertainty in that, right? The easiest path right now is to say, look, central banks are going to be on hold with maybe one more hike out of the Fed this year.
Academically, I don't think it's such an interesting time to have all these conflicting forces, where there's so many interesting things happening. For people living it with their money, it's stressful because there's just so much churn happening in the market right now. So it's something to watch out for. Can I just ask you about currencies, Looney? What do you expect to see if the divergence continues, maybe with the Fed and the Bank of Canada?
The general drivers of the Canadian dollar include commodity prices, growth, sort of the risk environment. And I would say that with the Canadian dollar, we're seeing a little bit of a stability in commodity prices and a rebound after the surprise cut and output. That's a tailwind. And traditionally, as you get to the end and then you start thinking about the Fed pivoting, that's a weak U.S. dollar story, which means supportive for other currencies. Canadian dollar will benefit from that. So that's, generally the playbook that a lot of people are thinking about right now, like the movement in the rates, pricing in cuts, pricing out those cuts. There's a lot of churn that goes on. We've been so conditioned to sort of quickly pivot, in the markets, whether it's equities or currencies or bonds. Basically, this bear market is pushing back on that narrative, and it's difficult to grab a trend here. But I would say, generally speaking, over the second half of this year, you're likely to see the Canadian dollar outperform based on a weaker U.S. dollar story.
Scott, always great having you here. Thanks so much.
My pleasure. Thank you.
That's Scott Colbourne, Managing Director for Active Fixed Income at TD Asset Management. Still ahead, a closer look at the commercial real estate market and why it has some market watchers worried. And later, frequent trading and the TFSA, why a court ruling this week could have big tax implications for some investors. You're watching Money Talk. We'll be right back.